Good afternoon. I am Chris Yancey, and welcome to the Resilient Alpha podcast. Today, we're speaking with Greg
So far, so
Mariash,
good. Yes,
who has
switch
3
back
decades of
in
experience navigating the volatile waters
20
of
minutes
global
when it switches
markets,
back.
and we've spoken about
Switching
that
back
quite a
again
bit
after
today.
that.
Greg is a definitive voice in emerging markets and multi-asset macro investing. From his formative years at Goldman Sachs to senior leadership roles at the Roy Hayton Group and Pictet Asset Management, Greg has built a career on identifying structural shifts before they become consensus. Having managed multi-billion-dollar tactical allocations and long-short equity funds across London and New York, he brings a cycle-tested perspective to a world currently grappling with deglobalization, shifting geopolitical alliances, and a return of costs of capital. Today, we sit down with Greg to discuss why the old playbook for emerging markets is being rewritten and where the next frontier of alpha truly lies. And do we know that this topic would be a little bit more relevant before we set it up? Welcome, Greg.
Thank you, Chris. Very happy to be here.
So we start off with asking about what we were going to refer to as the regime shift. You navigated the Great Moderation and the era of easy money. And now we look towards 2026. And do you believe that we have permanently exited the era of low volatility, or are we simply seeing a rhyme of the late 70s inflationary shocks?
I think we're seeing a combination of both. I think what we saw in the Great Moderation and the era of easy money was the exception. The world ran on high volatility, a little bit more inflationary environments than what we were accustomed to, especially after the global financial crisis. So I think we're coming back to an era of more opportunity given the higher volatility and more dispersion that we're going to see in markets.
Do you think that the world could end up going back to a period of trading blocks?
I do believe that's possible. And part of me wants to think that that is what's unfolding within our very eyes today. We've had comments in previous sessions on some of the deliberateness of what's taking place. If you go back and one of the comments that were made today was watch what Donald Trump says and follow that. So if we look at things such as the Hudson Bay Capital Report that was written by Stephen Moran, became economic advisor to the White House, Federal Reserve Board governor, and I think he's ceding his seat now to Kevin Warsh. They laid out pretty early on, right after the election, what direction these things were going to take. And the U.S. set out a very specific way of dealing with the rest of the world. 3 big pillars, and those pillars were, number one, if you're going to access the U.S. consumer market, the biggest consumer market in the world, that has a price. It's been free up to now, but now you're going to need to pay for it. If you're going to access the U.S. capital markets to recycle your trade surpluses, the deepest capital markets in the world, that's going to have a price. And if you're going to benefit from the U.S. security umbrella, that's going to have a price. So that alone, those 3 things alone, and I think point to the fact that they are setting up a world, and perhaps there will be 2 blocks. The Monroe Doctrine adopted to Donald Trump basically laid out a security strategy that was published about 2 months ago. It spoke very clearly about the same lines of organization, especially Latin America, and what's going to happen in the immediate sphere of U.S.
And when you think about the Monroe Doctrine, it's almost as if he's telling Europe, we're done.
I don't know that we're telling Europe we're done. I think we are aligning the easiest parts of the world, the ones that make sense, the backyard of the U.S. Latin America has been a very neglected area for the U.S. for many, many years. And I think right now the potential of what's going on there is being realized. I mean, I haven't spoken about markets yet, but one of the things that has been mentioned here, and one of the things that have taken place, is there is a global reallocation of assets. Even though the U.S. continues to receive inflows, we've started to see good performance from the emerging markets last year. And we've started to see very nice performance from Latin America. Just one case in point, for example, was the unconditional support that the Trump administration gave Argentina right before the midterm elections. They did not want to see the Milei administration's plan fail, and there was no hesitation. Now, I think the reason there was no hesitation is because Milei has pledged his unconditional support to Trump. He does that every single time he has an opportunity, including last night. There's a big Argentina week taking place this week here in New York. It was cocktail last night, 2 sessions today and tomorrow, where they're showcasing all the investment opportunities in Argentina. Every Argentine official who has spoken at that is basically reaffirmed this allegiance. So I think those blocks are building, and the opportunities are building.
Well, and given that, historically, emerging markets were viewed as a collective beta trade. And now that everything seems to be decoupling, how should investors redefine emerging markets in their portfolios?
So the way I like to think about it is we've had at least 3 distinct eras in emerging markets. So when I started, essentially it's called Era 1. It made sense to have something called emerging markets from the investing point of view, because you could actually put in a bag a group of countries that had the same problems. Those problems were volatile currencies, bad corporate governance, bad political governance, volatile exchange rates, which made the securities that were available to trade in those countries traded at a discount to their developed market counterparts. And the thesis behind that was eventually best practices will be adapted. Markets in those areas are going to converge towards the developed markets. From 1988, where the EM equity index was created, at this, and you also have to define what it is when you say emerging markets. What are the countries? What are the regions? What are the assets that we're talking about? Back in the day, I started my career in defaulted Latin American loans from the 80s that then became Brady bonds and somehow made it into debt to equity swaps. And all this helped open up these regions to the rest of the world. The second era was the one that was an era of permanent crisis. It was very easy to make money in emerging markets from the late 80s to 1994, but then we had a series of crises that started in Mexico, continued in Asia, went through Russia, went through Brazil, went through Turkey, went through Argentina. And then we emerge at the beginning of the 2000s with a lot of these markets having learned a lot of lessons. So by 2003, about 75% of what were the mainstream emerging markets were following some type of orthodox economic policy. Inflation targeting mainly by the central banks, changes in corporate governance, which then together with the great moderation and an era of easy money that we had between 2002 and to the global financial crisis, was what I call the Goldilocks era of emerging markets. And those were very, very fertile times to make money in EM, basically no matter where you looked. I mean, there were some countries that took leaps forward. There were some countries that took the proverbial 2 steps forward, 1 step back. Some countries didn't. Some countries actually, we like to say they were holding forks when it was raining soup. But those things have basically been internalized. Today is the third era of emerging markets, where we just cannot take a group of countries, put them in the same basket, and say these are the emerging markets. They're going to move like a monolith up or down depending on what's happening in the world. The right way to look at it is differentiating countries, but more importantly today, differentiating sectors and differentiating companies. I mean, question, could you have had the AI boom today without companies in emerging markets? I mean, the main feeders of chips, the designs still come from the United States, but the only people who can actually manufacture the chips to the degree that need to, and to the degree that we're going to need those manufacturing capabilities in the future, are in Asia, in Taiwan and Korea, a bit in China. We're trying to replicate that here. I think that's part of this coupling that we were just talking about. But it's going to take a very long time, and there's a whole sort of issues around regulations and environment that let you do that or don't let you do that with the cost and the celerity that would be needed to get those replacements. So world-class companies are coming out of emerging markets. The question is, how do you navigate some of the questions that we've been talking about today? The political volatility, the fact that, early on, one of the first lessons I learned in emerging markets taught to me was the sovereign has the first claim on foreign exchange, which means if you are an investor not located in these markets and not based in those currencies, you are going to be expecting cash flows coming from those places back to you as a return on your investment, and one day the return of capital, which is subordinated to the whims of whoever's running those countries. Now that is, as I said, a lot better understood by governments, and why they should not be doing these things. Yet we keep seeing these things. We see things such as when there's market volatility, a market that Korea, for example, which half of the investment index world considers developed, right? The FTSE indices that are followed by a lot of ETFs and mutual funds consider Korea to be a developed market. The MSCI indices don't. But Korea will basically curtail short sales when volatility arises in the markets. So you still need the skill set to understand. You can identify really good companies, but you still need the skill set that will help you navigate the times when the rules change. And so the investment process that I've always liked to follow is a process of selecting the investments, and then as a second part of the process, thinking about the tailwinds or headwinds that the environments that the companies are operating in give to the investment case. And a lot of times today, these headwinds or tailwinds are sectoral. So sometimes you get the impression that something is bad in a country, but there's certain sectors that are getting a lot of tailwinds. And so that helps you navigate a little bit this type of political volatility, regulatory volatility that we were talking about. So that's where the skill set is today. Understanding what are the good companies, what are the bad companies, the same as any other investment process has, but then looking at that country or macro overlay to see whether that investment case is actually getting headwinds or tailwinds.
Well, and I was going to ask the rhetorical question, do any emerging markets ever actually emerge into developed? And I think it's interesting that you brought up the Korea thing, because I think we've all been looking at this asset class with the same basket of names for so long. Now, obviously, Latin America has its boom and bust cycle, but some of the Asian countries have proven to be more resilient into the developed piece. You started bringing up a piece on sort of nearshoring or onshoring. What do you think that does for global trade routes? And what specific regions are structural winners from this now new fragmentation, and which are some value traps, I think is a way to say, that look cheap given this path to growth as the U.S. tries to attempt to bring back some of the stuff that we outsourced.
So on the first part of your comments, are there countries that have emerged? From an index point of view, it's a room of people that basically get to select every year what countries get promoted and indices, and what countries get demoted, what countries move from being in a index to being a standalone. That's one way to look at it. In my career, I've seen Portugal come out of emerging markets into developed markets and stayed there. I've seen Greece round trip. I've seen Greece graduate to developed, get demoted back down to emerging. I've seen Argentina come back into the emerging market index and get downgraded to frontier. And now, even though with all the reforms that are going on, now is a standalone market. And that has to do with the certain capital controls that still exist in the country. Geopolitically, if you look at it, I think Taiwan and Korea stand out as countries that could very easily be classified as developed. Why does FTSE indices think Korea is developed and MSCI does not? I think it's just business. If you need to take Korea today out of the emerging market index that MSCI runs, you have a 17% hole that you need to cover. And given that these are capitalization weighted indices, most likely to get covered by China, which is going to get even bigger. That just doesn't seem to be the right way to run an index. Taiwan, according to MSCI, has certain capital controls that do not let the country be promoted into the developed market indices. But last year, for example, if you would have made an asset allocation to emerging market equities and were faced with the two largest capitalization ETFs, you looked at EEM, managed by, I think it's Barclays, and you looked at VWO, which is managed by Vanguard. The Vanguard fund doesn't have Korea. Hence, because Korea was up 150-something% last year, you underperformed if you had VWO by about 12 percentage points. So, I'm here entering a little bit of the pitfalls of index investing, and going back to this point saying, is it the right way to invest in emerging markets just by putting in a bunch of countries that somebody has decided to call EM and just buying that basket?
Well, I'm sure you could do the analysis and find out what the winners are inside the index, like
Yes.
any other index.
Yes, and that's my proposal to people who are looking to invest. Is it's time. It's not a beta trade anymore. Going back to your first point, it could be a beta trade, but that runs out of steam. A more lasting investment proposition, finding the good companies, if you're long short, finding the bad companies, and then understanding the tailwinds and headwinds to each of those investment cases, that's the way you have to go.
Yeah, going off script a little bit here for 2 seconds, back to the continent. What do you think about Hungary and Poland versus the more traditional players over there?
Now, those, again, these are countries that one visits and say, this is great. This is better than a lot of places they actually call developed. They're small markets. Their weights in the indices are very small. So again, you have to go into the country, look at the sectors, look at the companies, and see whether there's enough liquidity to invest in these companies, and whether they fit your asset allocation. A lot of times countries may be known for something. For example, Mexico was seen as a petroleum country for many, many years, except there was never any direct play to actually buy Mexican oil and gas. Today, there's some companies budding, essentially because of the deep energy needs and energy infrastructure needs that Mexico has at this point, especially if it's going to become a reliable nearshoring opportunity, especially for the U.S. So going back to the winners, I think geographically, in terms of the know-how, in terms of labor availability, I think Mexico is one of those winners.
And I think that solves a number of other problems, if we can collectively do that. Switching gears a little bit to the AI divide. We've got the digital divide, but now we've got the AI divide. The U.S. leads, obviously, in this global arms race. How do you see that playing out in the emerging markets? Is there a productivity booster for BPO sectors in India or the Philippines, or is there a threat to the labor arbitrage model?
I think there's both. I think there's both. I mean, this is evolving so quickly. I was telling Chris the other day, I had an experience with Sirius XM. Everybody knows what that is. It's a satellite radio that you can have in your car. Every year, or sometimes 3 years, depending on the contract, I have to renegotiate with Sirius XM because my monthly payment goes from single digits to double digits. So what I do is I call, I tell them, I speak to someone, and then they basically honor my single digit payment again, because otherwise I say they're going to lose me. The last time I did that, I did it with a AI agent. The AI agent quickly asked me the same questions. And in the end, it said, okay, so if I leave you at your single digit payment, will you stay with Sirius? And I said, absolutely. Thank you very much. And we were done in about 7 minutes. So that, that's a threat to a lot of people who work in call centers. But at the same time, I think a lot of the studies, I mean, we all, I think, may have read or at least heard of the Citrini report a couple of weeks ago that basically said we're all doomed. It was a scenario analysis. We're all doomed because of what AI is bringing. It's going to leave us all out of work, and we're going to have big problems. And then we had a wave of people like Citadel and other outfits basically saying why that's not going to happen. I'm confident that we've had industrial revolutions. We had 2 in the 19th century. We've had the internet revolution in the 90s, and now we're having this. And every single time it did better things than bad things. We did get more productivity.
Yeah, I think that one of the reasons that everybody's trying to sell me a European soccer team is because they're all trying to figure out that there's going to be a lot more leisure time for people. So everyone's going to be betting on Kalshi and watching, B-level European soccer. In terms of active and passing investment in the emerging markets, the index, like we talked about, has been struggling. Why is the current macro environment characterized by high dispersion? As we mentioned, the perfect storm for active boots on the ground management. So I think we touched upon this. Is it going to go away from index and country by country allocation?
The mainstream index investing, I think, is more akin to beta. So for the tectonic type move that we had last year, where, for me, it became clear that from these reports that I cited before, from what the Trump administration has been saying, what Scott Bessent has been saying, it seems to me that a strong dollar is not in the interest of the type of policy that the U.S. government wants to run today, for many reasons. We can get into them if you'd like, which gave a very, very strong tailwind to emerging markets, right? We've heard in a couple of panels here today, when the dollar is weak, EM does well. When the dollar is strong, EM struggles more. But that doesn't take away. So for macro, I still think that the index vehicles can provide solutions. But there comes a moment where you plateau, right? The dollar will not depreciate forever. It'll get to a level where the government is comfortable, and then the indices will start to either pull back or they'll plateau, and you're going to start thinking, I'm not making enough money for the type of volatility that I'm taking. That's when the real bottom-up active management takes over.
We haven't really touched upon it in terms, I don't know if you know the numbers or not, in terms of people's 401k allocations or other sources of funding. What is the percentage? Because back in the day, everybody was selling you diversified, and then we've had this Mag 7 run where, concentrated position, outperformed. Do you have any, are people allocating their portfolios in any sense to these markets?
So a lot of the wealth management groups at the large institutions do reserve a portion of their global asset allocation to emerging markets. When I was with the investment strategy group at Goldman Sachs, we actually decreased that in favor of U.S. Harvard University has a 9% allocation of their endowment to emerging markets. So it varies. It varies, but there's not a lot of exposure.
Yeah, I didn't think so, because when you have these concentrated runs, people don't like to do it. Resilient Alpha likes to also do these lightning rounds as we come to the end of our conversation. So we're just going to go through a couple of questions for you.
We have some audience questions also.
We could do that now if you want. Sure.
Yeah, if there's any questions in the audience.
Anybody have any questions?
Because I have a couple.
Okay.
Great. So would you say that the whole issue that's the U.S. is, retilted towards Latin America, a lot of it's because China has been focused on it, while U.S. is not focused on it at all?
Yes, I think that China was making very large inroads into Latin America, as it's made in Africa, and as it's made in anywhere where their Belt and Road project or New Silk Road project has taken them and countries have accepted. And we've seen recently that some countries have now been rejecting some of the Chinese overtures. But yeah, absolutely. I think there's a restructuring of global blocks.
Isn't there an issue with the ability of the U.S. to kind of sustain focus?
Yes.
Because let's face it, the U.S. has overthrown half a dozen Latin American governments or more over the years, and they did it and they walked away and said, well, hopefully it all works out and let us know in 10 years, whatever. The U.S. has never really been able to focus too much on one location or another. So there's that, and then maybe we change administrations to a different party. Your thoughts?
My thoughts are the same as yours in that one. I think basically the U.S. has dropped the ball a lot in that region. There's nothing that we can say that's going to give us continuity in these things. So I met 2 years ago when he was considering his run with who is today the president-elect of Chile, Jose Antonio Cast. And Chile is, it's an interesting country because its exports mainly go to Asia. So one of the questions that was posed in a small group discussion with him was, what if the U.S. asks you not to engage in the level of trade that you have with China? And the answer was, well, what do I get in return? Because I go to Europe and I try to talk to European governments about letting more Chilean fruit into Europe, and they say no because they protect their farmers. And I go to U.S. and at that point there was no lithium coming in from Chile to the U.S. It was all being exported to China because of regulations. So those are the things that need to change.
Are you able to talk about the difference between an American company's perspective and a Chinese company's perspective towards trade? I mean, and the fact that these Chinese companies are signing 1% and 2% margin deals, and Exxon won't go into Venezuela unless there's huge profit involved?
Yeah, that's part of the Chinese model. I mean, today David Skilling was discussing what I think are the strengths of the Chinese economy, and you were highlighting the margins and the fact that a lot of these companies work at losses. How long can it go on? Somebody asked. And the answer is it can go on for a long time. But the longer it goes on, the more precarious it becomes because it's built on debt. And today, the cash flows that are generated by the projects backed by that debt are not enough to cover the debt. Not some of the interest, but never to return the principal. Now, we know the whole world works that way. But in China, it's getting to the point where the transfer of wealth from consumption to industry is essentially wreaking havoc on the future, on the potential future of the Chinese economy. They did the same thing in the early 90s. It resulted in probably the biggest bank bailout in history. During 1999 and 2000, the Chinese bailed out the 4 or 5 largest banks, essentially in a huge wealth transfer that came from households to the banking sector. And it took them about another 20 years to almost put themselves in exactly the same position that they were. So today, the problems that we deal with is China does not consume enough. It wants to sell its products to the rest of the world. I think somebody was showing a chart with BRICS and how, you know, markets are rerouting trade that way, right? So China just reported a $1.2 trillion surplus. That is 1.5% of world GDP. It can't go on for much longer. And I think what we're seeing today in the world, certainly the backlash from the US to China, starting to begin in Europe, and then some of the peripheral countries starting to decide which bloc they want to belong to is because of this.
As you know, there's a birth dearth in the West, right? For every Western consumer that dies, they need to be replaced by 6 new emerging market consumers.
Yes,
say for emerging markets.
That the existence of a BRICS trade bloc is a chimera, because when you add it up, the BRICS are surplus amongst them, and so who is going to they don't buy enough from the rest of the world to absorb that. So we're essentially going to have to rebalance trade in the world somehow.
Well, and I think that that's kind of the conversation that the administration is having. I mean, at the previous event, we talked about whether or not there's a shadow Bretton Woods 3.0 going on, you know, that and maybe this whole Venezuela, Iran, you know, domino theory that we're trying to push here is trying to re-irrigate the globe's capital. Let's just bang out some of our lightning round questions here. Yeah. So overrated or underrated, universal basic income as a solution to AI displacement in the global South?
No, I'm not a fan. I'm a fan of entrepreneurialism. I'm a fan of creative destruction, in order to basically build on more solid bases. We don't do a good job in the world of that. We like to bail out things that are not working. But no, I'm not in favor of UBI.
Yeah, the conversation around the UBI pops up every once in a while, and then it definitely fades back into the Berkeley think tank where it kind of belongs. If you had to hold one asset for the next 10 years and couldn't touch it, physical gold, Bitcoin, something in the emerging markets, what would it be?
So you're not saying what percentage of portfolio. So I would say it's gold. It's gold.
And I agree with that. I think that gold is definitely there. Oh, okay. What do you have to say? I mean, I think we didn't touch upon tariffs, but I think in light of what's going on, you know, with oil down like 19% today or whatever, the volatility today. So maybe you can close it out on something like that.
Yeah. Look, I mean, if I can leave the group with one observation, is essentially don't think about emerging markets as a block anymore. That era is done. Think about it as countries, think about it as sectors, and look at the companies, because there's really, really good things happening. It's just a question of knowing how to navigate that to be able to have these things in your portfolio and keep them for enough time for them to give you the return on investment that you're looking for.